When President Trump consolidates his control over the Federal Reserve, which won't be long now, as discussed in the previous Macro Watch video, that will enable him to accomplish two of his highest priority economic objectives. One, slashing U.S. interest rates, and two, devaluing the dollar. This video will focus on the dollar, why Trump wants it to fall, how his control over Fed policy will ensure that the dollar does fall, the impact that a sliding dollar is likely to have on global asset prices, and the best way for investors to profit from the significant depreciation of the dollar that's likely to occur during the months ahead. President Trump believes that an overvalued dollar is largely responsible for the United States' massive trade deficits and for the hollowing out of U.S. manufacturing that's occurred since the 1980s. He's right. Before the Bretton Woods system broke down in 1971, when money was backed by gold, trade between nations had to balance. That's because when a country had a trade deficit, it had to pay for that deficit by shipping its gold to the trade surplus country. If large trade deficits persisted, the deficit country would run short of gold and would have to stop buying things from other countries. So trade would come back into balance. But the need to pay for deficits with gold ended with the collapse of Bretton Woods. Afterwards, the U.S. could pay for its trade deficits with dollars that were not backed by gold. From then on, the U.S. trade deficit exploded. Last year, it set a new record high of $1.2 trillion. Traditionally, when a country had a trade deficit, its currency would depreciate and help bring the deficit back into balance. However, after Bretton Woods collapsed, the central banks of the trade surplus countries bought dollars to prevent the dollar from depreciating. This can be seen in the surge in foreign exchange reserves from $50 billion in 1971 to $13 trillion in 2021. President Trump has made it clear that he wants the dollar to fall so that the U.S. trade deficit will come back into balance. He's said so many times over the years. The dollar index, which measures the dollar against a basket of currencies, is shown in this chart. It's fallen 10% since January. However, at 97.6, it's still above its long-term average of 97.4 going back to 1971. It's very likely to continue to fall. The dollar index is closely watched and widely discussed, but the exchange rate between the dollar and other individual currencies is of more practical importance. The next few slides will focus on the dollar's exchange rate with the euro and the yen. We'll look at trade balances, inflation rates, interest rate differentials, and Trump's strategy to devalue the dollar, as spelled out in a paper by Stephen Moran, the chairman of President Trump's Council of Economic Advisors. Let's start with the euro. This chart shows the euro